Hi, my name's Dennis Jones from CCA Financial Planning. I'm a senior financial planner here. Today we'd like to have a bit of a chat about investment concepts, and at CCA we're committed to helping our clients make smart decisions about money and about investment. So the concept of the two-bucket approach to investing is one we've used to help try and simplify what can be often overcomplicated. Especially with interest rates now, interest rates are starting to fall. I think we're all aware of that. If you've got a mortgage, that's great. But if you don't have a mortgage and you're relying on investment money to provide you with income, then it's not so good to see interest rates progressively fall. What does all this mean? The two-bucket approach is one way to help simplify this. So what we try and do with our clients is to make sure, especially as they're approaching retirement or they're in retirement, that they've got enough money in what we call the safe bucket to provide a regular income stream. And the safe bucket is a bucket, if you like, or a portfolio where we have cash, we have term deposits, we have fixed interest and bonds. Now bonds can be either government bonds or they can be corporate bonds, but they're a very safe investment and they provide regular income. So that's the safe bucket. The only problem with the safe bucket, of course, as I mentioned earlier, interest rates are falling. So typically cash and term deposits, where we were getting 6%, 6.25% a few years ago, we're now getting 3%, and by Christmas this year it might be around 2.8% if interest rates come down further. So that's the safe bucket concept. Over here we have the growth bucket. Growth bucket typically would have shares, property, infrastructure investments. They can be held either directly, direct shares or direct property, or they can be held through managed funds, or more recently, exchange-traded funds, what we call ETFs. ETFs have become a very popular way to have a diversified portfolio because the fee structure is incredibly low. Typically an ETF has a fee of around 0.3, where a managed fund might have fees of 0.8 to 1%. So just to recap, the growth bucket, shares, property, infrastructure, and they can be held in different ways, directly or indirectly. Now, growth investments, last 12 months, for example, a good growth portfolio with Australian shares might have returned around 20%. But a few years before that, of course, it was negative 20. So growth investments, by definition, go up and they go down. So they must be considered a long-term investment strategy. And that's why, of course, we combine the two. Safe investments in the safe bucket and growth investments in the growth bucket. The other thing over here in the growth bucket, blue chip Australian shares in particular, high income, high yield shares have been producing dividends of 5 to 6% now for a few years. So the growth investment from shares can produce strong income, which flows, the dividends flow into the safe bucket. And from the safe bucket our clients are drawing, especially in retirement, they're drawing regular income from pensions, and that regular income from the safe bucket, if you like, is being topped up periodically from the growth bucket. The other advantage of this approach is that if we do have another downturn in the share market, and at the moment in the news is situation in the US with their debt ceiling and the political problem they've got there resolving that, we might see a drop in shares globally, which would of course affect the Australian market. By having this approach, our clients aren't forced to sell growth assets when they might be in the short term down in value. They've always got enough cash to live on. So this approach, even though it might be managed as one portfolio, by looking at it separately, safe investments, growth investments, combine to produce liquidity in the short term, but better long-term returns for you. So I thank you for watching this today. Please look forward to our other videos on CCA YouTube.